doing it one deal at a time for myself at this stage of my career is not where I want to go. I'd much rather help other people that are doing that sort of thing or running their strategy and help them basically not make some of the mistakes that me and my partners have made over the years, and use what we've learned to accelerate their growth and grow the industry.
Tim is one of the most authentic and genuine people I've ever met.
Sincerely believe he's coming from a position of giving, and that means a lot.
You're going to make huge progress.
Welcome everybody to today's Capital Raising Show. I'm your host, Tim Mai, and today I have a really awesome guest on the line with us. He has a ton of experience. I didn't even realize it when I sat down and talked to him at Best Ever Conference until I saw his bio. I was like, whoa, this guy has raised over $750 million. That's a lot of money. Darris Cassidy, he is the CFO and co-founder of Verivest, and is a highly sought after real estate advisor for 20 plus years in the industry. And he is the primary person responsible for raising that $750 million of investor capital across 100 plus individual deals, several 506 Reg D pool investment funds. And his specialty is developing relationship with high net worth individuals and family offices. At Fairway America, they have closed over 1,000 deals. Currently have around $1.2 billion asset under management. A lot of money, all kinds of different properties, everything from single family rentals to multifamily, office, retail, self-storage, industrial, hospitality, pretty much anything we can think of, right? And so I'm super excited to have Darris on. Darris, thank you so much for being on here with us today, buddy.
Yeah, thanks, Tim. Glad to be here. Looking forward to the discussion. So, yeah.
Awesome.
Yeah, hearing that bio is interesting. It sounds a little crazy that we do a little bit of everything. So we'll get into what that business strategy is all about. But yeah, happy to be here and looking forward to sharing some of my experience.
Yeah, definitely. Let's start out. You can share with everybody a little bit about your business model. I know you have two different companies. There's Verivest and then there's Fairway America. So we'll start with Fairway America first, and then we'll get into Verivest later on.
Sure. So the two companies work together, but are separate. I separate them just by saying Fairway America is the investment side of the business, the asset management side. Verivest is more of the service side of the business that we work with other real estate managers. Fairway America was started by my business partner, Matt Burke, back in 1992. We're headquartered in Portland, Oregon. During most of the 90s, Fairway was doing hard money lending against commercial real estate, just one deal, matching it up with one or a handful of investors at a time. In 1999, Fairway created its first pooled investment fund, 506 Reg D fund, which at the time was pretty rare. And of course, the internet was not even close to what it is today. Made a lot of mistakes in setting that fund up, hired attorneys, paid a fortune, raised capital, managed it, made good returns for the investors, learned along the way, rolled it into Fund 2, Fund 3. Fund 4 ended up having, and was all hard money lending at the time. Fund 4 had a $50 million line of credit from Wells Fargo Capital Finance. It also had around $50 million of high net worth investor capital. It's roughly $100 million of capital to play with, and funded really well. And then the Great Recession hit, assets continued to do well, origination opportunities increased, but the banking sector just was getting crushed. So Wells Fargo wanted to be paid off and basically called that line due, forced us to start selling off assets in a terrible market, repay that line, and then return capital to investors, ultimately wind the fund down to zero, essentially shrinking the revenues of Fairway to zero. And I joined at that time to help through that process. I had been doing my own thing prior to that, all in real estate finance and funds as well. So that's when we made a pivot to, we needed a new business model coming out of the Great Recession. So in 2012, and this is how it relates to Verivest at this point, we began getting phone calls from a real estate managers saying, hey, I know you've run a lot of funds, you've managed a lot of investor capital. I'm looking to start my own fund. My attorney is great at giving me legal advice. My accountants understand the accounting side. Nobody seems to understand the business parts of running a fund, how to launch it, manage it, structure it, raise for it, administer it, communicate, so forth and so on. So we started an advisory business that at the time Fairway was running to help other people set up their own funds. And that business took off on us, I think, more so than we had expected. And so we began helping set up funds. And around 2013 or so, a lot of those funds we started to get off the ground, really started calling back saying, hey, this is great, I have a fund, but now I have no idea how to do the administration, the accounting, the investor capital accounts. So can you help me with that? So we began doing the back office administration for all the funds we had helped set up. And so that became a service that we still do today. And then the next thing they need, of course, is I need more capital. And so we have done various things throughout the year regarding helping to capitalize the people that we help set up funds for. That's also still something that we're doing. We can get into some more of that. But that was all being done by Fairway, along with in 2013, we launched Fund 6, 2014, we launched Fund 7, 2017. We launched Fund 7 QP, and we've launched 5 funds since then, 5 of which are still active. So that's just real high level. That only gets us to about 2017. So I can keep going or pause for a second there.
That's awesome. All of these funds that you have, does the fund do fund of funds where you're raising money for other deals, or do you guys source your own deals, or both?
We do not source our own deals, except for occasionally some debt. We'll do some loans still that just come to us, but we do not find our own deals. The investments that we make are into other funds. So as a fund of funds, we also make investments into operating companies of managers to help them grow and scale. We also make investments, equity investments into both LP and GP positions of syndicators, for lack of a better word. We like to find people. We find relationships. And so we have relationships with groups that may be doing, just to throw a random one out, value add multifamily throughout the Midwest. We will partner with that particular sponsor. And by partnering with them, they get our entire legal resources. We'll raise all of the equity for them or invest all of the equity, both GP and LP equity. We can find the debt if they don't have those relationships. And then we'll do the ongoing investor relations, the ongoing accounting, the ongoing communications, and so forth and so on. And what that allows for is them to focus on the real estate. So they're finding the deals, they're executing the business strategy, and they're managing the oversight of the day-to-day. Of course, if they start doing things that are not in the best interest of the investors, we have control rights to step in and take over those deals. But for the most part, we're looking for managers that are growing and scaling either as syndicators or as fund managers that we can invest capital into and alongside of to help them scale their business, which helps on the Fairway America side, helps grow our AUM. And then by Verivest doing the accounting and administration, it helps grow our assets under administration on the Verivest side. Those two things are ultimately the goals of the two companies, to grow our AUM and our AUA.
Gotcha. Very cool. I don't know if you even remember what your first capital raise was like.
I saw it's funny you say that, because you sent over some questions ahead of time and went through them, and that was the one that stood out to me as, wow, I'm going to have to go back in my memory as to what that was. But I don't think this was my first one, but I'll tell you the story that kind of popped into my head as you mentioned that, because I told this on another podcast that I was on recently. But in the Great Recession, as some people may or may not recall, there was a lot of single family foreclosures going on. And the banks were holding those homes until they needed to liquidate them for one reason or another. They'd often basically dump those out the back door when their share price could absorb that loss. And so I was acquiring my first fund, and I'd call it a mini fund, if you will, was acquiring these packages of single family foreclosures. And on average, the cost of those homes was, it sounds shocking, but about $7,500 per house. So I'd buy 50 50 homes at a time sort of thing. No due diligence was allowed. You had 24 hours pretty much. You don't get keys. Let's hire a locksmith and go figure it out. So a crazy strategy, but I just recall accidentally raising capital for that, and which is why it turned into a fund. I was using my own capital as well as some close relationships, their capital, and I was sitting in a Starbucks kind of looking at a package of homes, and someone walked up behind me and started asking what I was looking at, and started talking to him, and created a relationship and raised $250,000 from him
Wow.
that week. And that, for that reason, I formed my first fund, and that I then raised a little bit more money for those funds. Obviously, with that low of price, you don't need a whole lot of money for that strategy. But that was one of the first, that wasn't the first equity that I raised, but that was one of it, the times that stood out when I read that question.
And what about some of the raises that you have done that was challenging, that you can share with us a story around it and how you overcame it?
Yeah, so I'd say that maybe I'll start off with funds. Funds are almost always challenging to get started on the raise. There's a interesting dynamic and capital raise situation that happens, or difference between funds and syndications. Funds are, I'd say, harder to get off the ground, get the momentum going. But once you get that momentum, you're pitching the same thing over and over again. But they are harder because they're generally blind pools. So you're more, it requires more of a story or a strategy that the investors have to believe in, and they have to have a great deal of trust in you, as opposed to going out with syndications that you can point to this deal at this address with these numbers and this time frame. So when you ask that question, all of the funds that I've raised for that first 3 to 6 months is hard. And then once you get it going, it gets quite a bit better. On the opposite side, syndications, the ones that we've struggled to raise for or have been more challenging, really have to do with the deal itself, I think, and that the story or the strategy doesn't resonate with the investor base. And that has happened on a few deals. I can think of one deal in particular where you look at it, and as a real estate person, it's a fantastic deal. Great look. It's an industrial deal, right? So great location, great numbers, great tenant base, all the things you want as a real estate person. But you show the pictures to the investors, and it's an ugly industrial deal with the chain link fence around the perimeter of it. And it's just not sexy. And that deal we struggled to raise. And there's been a few others like that kind of have a similar deal. Whereas on the opposite end, if you show someone a really nice looking asset, that helps, or a really good story, such as we've been doing a lot of acquiring hotels to convert them into affordable multifamily housing. People love that story. You're not displacing tenants. You're not raising rents on tenants. You're creating new housing, and you're doing that with some hotels that are becoming obsolete and ugly for that particular community. Each raise takes on its own strategy and has its own challenges.
Wow. Okay. And what are the different asset types that you have raised money for?
I've raised money I've done a lot of debt placement on single family land and land development, or raw land. Not a lot of that recently, but more so where we have placed a lot of equity is value add multifamily, neighborhood retail. We've acquired vacant big boxes like Sears, JCPenney's, Macy's, converted that into self-storage, acquired hotels to convert into multifamily housing. We've done office, not generally not towers, but more like flex office, suburban office sort of thing. I've raised equity for in industrial buildings, and I'm probably forgetting a few others, but that pretty much covers it. Pretty much all types. Again, to go back to our strategy, we find people that are executing their strategy, and then we basically find what we consider to be the best of them, and we'll put as much equity into that strategy as we can, as long as we believe in that person and wherever we may be in the market. So we do maneuver. Like right now, I'm not putting any equity into office, but we certainly have done that over the years. The other thing we've done quite a bit of lately is single family rental communities.
Gotcha. And just out of curiosity, for the single family rental community, do you flip them to an institution players afterward or what?
That will be the play. We have not been taking the development or construction risk on those. So we've been buying from some national and sometimes regional home builders once the project is done or one of the phases is done. And then we'll cash flow those for 3 to 5 years and then package them up and look to exit to a BlackRock or some larger institutional type fund. We may also recapitalize those with one of our own funds, just depending on where we are at the time that we're looking to exit those.
Gotcha. All right. So with all the different raises you've done and all different asset types, and I know you raised from both retail and also family office. So I want to talk about the retail side first here. What are your top 3 favorite places or marketing channels to attract retail investors?
Yeah, that's the other question I saw on this list that is difficult. I've tried just about everything, and there really are not things that stand out as the right channels. It's a little bit of everything. And that I advise and help people raise capital and whatnot. And that's always one of the things they're most frustrated or disappointed in, is that there just is not an easy answer or a silver bullet to any of this. I've literally traveled around the world raising capital. I think that for retail investors, for me, what has really worked is working the network and word of mouth and referrals. The transfer of trust is a big deal with high net worths, right? It takes a long time. These are big decisions for them to part with their money. So you need to be trustworthy in order to have them invest with you. But beyond that, if you can have them introduce you to someone else and transfer that trust to someone else, that really accelerates the probability that next person will invest. So what I tell the people that I help raise capital is you focus on kind of your tightest circle first and really do well by them. And then naturally try to get referrals and introductions. And of course, you want to do that in a way, it's why I use the word naturally, that you're not pushing for that or coming across desperate when you're doing that. But that would be the number one way, I think, to expand the high net worth capital base. And then it's just being active and being out and involved, like going to events. And it's not even necessarily real estate events, but being part of your community, showing up at charitable things that for your community and being yourself. And for me, the other thing that has really worked, and it's become natural for me at this point, but it was a conscious effort, is really to just ingrain myself into the lifestyle of being around high net worth individuals and be a high net worth individual and live in those neighborhoods and go to those restaurants and travel to those places and hang out with high net worth individuals. And by hanging out, that doesn't mean you're constantly, I've seen people do this, pitching people just nonstop, but it's being a genuine, friend to high net worth people. And that can turn into capital over time, but all of it just takes a long time.
Gotcha. So would you say then most of your strategies are more of like in-person meetings, whether it's at events, in the community? It's mostly like belly to belly in-person settings. Is that correct?
I think that would be correct. Fairway America has put on, and Veravest has put on a few, but events for investors over the years where we'll bring a few hundred investors to really nice resorts and chat about this sort of investing and bring some of our sponsor partners with us. We have about 650 active investors at the moment. And I have probably met 85 to 90% of them in person over the years. So
gotcha.
Usually before they make an investment. So yes, meeting people in person. I've gone as far as having an initial phone call and with someone and getting on an airplane the next day to fly down just to take them out to lunch. And those sort of efforts go a long way with people. And that particular individual, that happened probably 5 years ago. He's since introduced me to probably new investors, which goes back to what I said earlier about getting those referrals.
Right. That's really good. So what would be their investment capability before you would do something like that, to fly out and take them to lunch?
I'll answer the question as to when I did that. I think that individual was talking about maybe $100,000 or $150,000 into our fund. And it was flying from Portland to LA. So it's an easy flight down and back in a day, not a big
Right.
deal. We have people in my office that would do that for those dollar amounts still today. You never know what's behind, you just never know what's behind it, because that individual now has probably around $1 million, $1.2 million with us, just because that initial investment may not be huge. And to my other point, he's introduced us to 8 other people. So collectively, he's probably helped bring in roughly $5 million, something like that, over the last several years. So you just never know where these things are going to turn into.
Right. Oh, that's really good. In terms of referrals, do you have a strategic, like intentional way of asking for referrals? And also, do you ask for referrals even if they don't invest with you, or do you focus your referrals just on the investors that have invested with you?
That's a good question. I probably have gone about the referrals a little bit unique. I think as a company, we have been strategic about sending out emails, and our investor relations people intentionally going on a referral campaign and asking. That doesn't seem to get as much success as what I'm about to say, which is that, again, just putting yourself in the position to get that referral, such as every time I go golfing with one of our investors, they'll bring along 2 other buddies or 6 other friends. And that's not necessarily a referral. It's an introduction just to go golfing. And it's those sort of things is more how I personally go about it. But as a company, we have tried some of those more systematic ways, and it's had some success, but it's also a little awkward for people, right? It's like people don't want to introduce their friend or their family member to a salesperson, which I think is the other reason for some of my capital raising successes, is that I try as hard as possible to not sell people or come across salesy. I almost never ask someone to invest. I can't think of a time that I said, do you want to invest in this thing, or will you invest in this? It's a different approach that makes them more comfortable. And I think that's what really gets the referrals, is knowing that I'm not going to pressure their friend into something.
So let's get into that. How do you make the ask then? If you don't ask directly, like number one, how do you even get them to say, yes, I'm interested, send me your deals? And then how do you make the ask?
Yeah, a lot of times it's just their curiosity to start asking questions. Just like anything, the conversation, what do you do, comes up if you're meeting them in person, or they'll find us online. And then of course they know what we do. And then it's just trying to help educate them on what we do, why these investments can be of interest to people, what our investors look like. I think starting to demonstrate some social proof. Social proof is another big thing. I mentioned this transfer of trust, but social proof is a big deal to people, that they want to know that they're not the one person that is like being duped into investing into something. If you have an event and there's 50 other people that look just like them, they get a lot more comfortable. And I'm going on a little bit of a tangent with this, but it relates. Is we had an event, one of the first events we put on back in 2014, and we put out this marketing stuff, and a bunch of people showed up to it in Seattle, and we recognized that we made a mistake afterward because we had not encouraged people to bring their spouses. So my follow-ups, it was a lot of, I'm interested, but my spouse thinks I'm an idiot if I make this investment, basically, or they think I'm getting tricked into something. And so the next year we said, hey, please bring your spouse, and we'll wine and dine and feed everyone. So we'll make it fun, even if they're not interested. And so a lot of the spouses didn't even come to the business parts, but they'd come to the socials parts of things. And just that social proof greatly accelerated the success of those events going forward. So backing up, that's kind of part of this idea of being natural and not asking for it, You want them to come to the conclusion on their own that this is a good decision for them to make, and have them ask you to make the investment rather than you asking them to make that investment.
Okay. And then these events that you host, are they like sport outings type events? Are they educational type events? What type of events are they?
So we've done several types, not sports as much. So we used to put on some just huge events, like we would rent out an entire high-end resort, the Montage in Laguna, as an example, the Breakers in Palm Beach, Florida. And we would bring a lot of our sponsor partners, real estate managers that have strategies, and it would be very educational, but it would almost be more social. So the investors could come in and we'd pay for their room, their drink, all they could drink, all they could eat. We'd had big speakers, Jay Leno, George W. Bush. We had Magic Johnson, Emmett Smith, David Faraday, and we'd put these big events on, huge budgets, and educate people on why these type of investments are potentially good ideas for them. And then again, you'd get this transfer of trust, you get the social proof, you would demonstrate your expertise in the field. And those events raised, we don't have the exact numbers, but over $1 billion that not only went to us at Fairway, and that was over 6 or so events. Not only came to Fairway, but went to the managers that we invited to come along and present there as well. Those were managers of that Verivest usually had set up the funds for, or their syndications, and then did that ongoing administration, which for them was the other transfer of trust, that the investors are saying, I know who's behind Verivest, and I trust that they're doing those books correctly, and they're handling this, and they structured it correctly. So I like that, and therefore I'd put money with this manager or that. So those are the type of events that we've done over the years. And then we've done smaller events where we'll fly into a city and invite 20 or 30 people to come out for a dinner, and we'll rent out a private room. And it's similar. It's not a big business salesy pitch. It's come and hang out, and we'll talk for 10 minutes, present a 10-minute thing. And the rest of the time is just chatting and hanging out.
That's pretty cool. Let's talk about the investor profiles of everyone that you've raised money from. Is there a bucket of the type of investor that you've have more of in your group of 600-700 plus investors?
Sort of. They're all accredited investors, so start there. But I'd say the pattern is, it may be obvious to some. You've got dentists and doctors. I'll categorize it like this. You have dentists, doctors, and attorneys. They're very similar. They hang out in crowds together. They're friends, they're buddies. You can find groups of them. They have disposable income. They're smart, so they get this stuff, and they often are looking to diversify outside of the stock market. Then you've got entrepreneurs. Entrepreneurs, to me, are some of the best investors because they are used to making their own decisions. They usually don't have financial advisors that usually will tell them, don't invest in that crazy thing, put all your money in stocks. And entrepreneurs move fast. They make quick decisions. The good ones have ongoing excess capital to invest. So they'll make repeat investments over and over again. And they're, just because I'm an entrepreneur, I like hanging out with them, talking with them. So it's personally fun for me as well. And then you've got your executive types that have saved money over time, the high income earners, whatever that may look like. And that's the primary categories. And of course, there's a few other here and there, and then you can get into family offices or a whole different world. But those are the primary categories of what our high net worths look like.
Gotcha. Okay. In no particular order, or was there an order to it as well?
Executives would be some of the lowest number. I think entrepreneurs are probably fewer, and there's just fewer entrepreneurs than there are dentists, doctors, and attorneys. So I think, I don't know the exact, we have the stats, but I don't know them off the top of my head.
Okay. And then when you were doing the events, in marketing for the events, did you do a direct mail campaign to these people to attend, or was it mostly people that are already in your network?
So we would start with the people in our network, and I'll start with our earlier events because the last events, it got to a point that we were turning a lot of people away because of capacity reasons. But our earlier events, when we really had the effort to get people to show up, it was more starting with the investors in our network and then asking them if they knew anyone that looked like them that might want to attend the event. And then again, you make it easy for them to say yes by it's at this really nice resort. We're covering all of your expenses. And that's a pretty easy thing for a lot of people to say yes to. And that's also why we vetted them quite heavily, because we didn't want people just showing up for the vacation aspect. So it was like we wanted to make sure they were serious about considering an investment. And as better and further into those events, that's what we started doing, is vetting people by how serious, how ready they were to make an investment, how much they were considering, and whether or not they could bring a friend. And we tried to get one existing investor and one brand new relationship.
Gotcha. Okay. And then in terms of the topic that you use to attract them, what's some of those topics?
Passive investing into real estate, and real estate's tangible, and there are tax benefits, and there's the possibility of diversification. And there are a lot of opportunities, whether it's investing into debt, investing into GPs, investing into LPs, investing into development, value add, stabilized. There's just so many options for people to customize whatever their objectives, their risk tolerances, that sort of thing. And I think it's also playing off of people's hesitations or anxieties about the stock market, and the fact like stock market's so huge and they're just one investor and kind of along for the ride, which doesn't make that a bad investment. It just means people want to diversify outside of that.
Okay. And then, so I'd like for you to share what your sort of nurturing process looks like. So once someone, especially if they're new, they get into your world for the very first time, or they could attend your event for the very first time, what does the nurturing process or sequence look like?
Yeah, my team at Fairway America has done a really good job of building that out over the years. So it's definitely evolved over the years, and it's hard, I think, to do this without skilled marketing and investor relations people. It's certainly beyond how I used to do it when it was more one-on-one. But at this point, people will get their contact email information, and then they get educational pieces that we put out, blogs, webinars, as well as access to deals. It's a slow market at the moment, but in 2021, we closed about 40 acquisitions, something like that. And so they were getting emails most weeks with a new investment opportunity, and that doesn't count the funds. Those were on the syndications. So just showing those to them, following up with phone calls, and understanding, keeping a pulse on what their particular objectives are, whether there's some investors that are looking for cash flow and some are looking for longer term appreciation, and for some taxes are a big deal and for others they're not. And we have really built out a pretty robust CRM with a lot of notes on the investors around those things and created lists around those things, so we have a decent idea of who we should be reaching out for which type of deals. So they're constantly getting touched. We have quarterly statements that go out, quarterly investment updates on whatever investments they are in. We'll have quarterly webinars on each of those investments so they can join those. And then on the Verivest side, we're constantly putting out educational materials there that, even though most of it is directed toward real estate managers, it's a lot of investors like to participate in those just to increase their education levels in the space as well.
I see. Very, very cool. And you raise money for other managers, right? Fund of funds. What is your pitch to your investor that have them invest through you instead of going directly to the manager?
Yeah, so we have it set up a little bit different than what I know a lot of people have their fund to fund set up. Ours is set up more as I will say, we can make true fund of fund investments like you're describing. Our investors like the oversight and the fact that they trust us and our underwriting abilities, so they don't have to underwrite it. They know if the deal starts going sideways, we're going to step in and control it. We're generally getting some of those control rights. We also are taking better economics because we're writing larger checks. So they like it for that sort of reason, as well as the diversification they get in a fund, as opposed to going out and finding individual people and not knowing how to underwrite not only the person, but the deal. So that's the answer to the way you phrased the question. The other thing that we do is more of a co-manager arrangement where we are part of the GP. And so they can't go around us to that person. They can try, but that sponsor is just going to turn them right back around and say, there's only one offering, and that's through Fairway America. So you have to invest through Fairway to get access to that deal. We do that in a way to try to not, and this is the issue with fund of funds, to try not to have a double layer of fees. So we have found ways to structure deals so there are not two layers of fees. So we've been able to eliminate that argument. I'd say that we did have a fund that had the double fees, and it was a lot harder to raise capital with that argument. So we've figured out ways around that at this point.
Do you mind sharing what that way is? Like, how do you go about doing that?
Yeah, so we just take a co-GP seat next to our sponsor partner, and we share in all of the fees and promotes. So it's one fee set, one promote, and that partner, and the phrase that we use a lot is, put the money or put the fees where the work is. As an example, if Fairway is the one that is doing work on the asset management side or the investor relations side, that ongoing asset management fee, the majority of it will come to us, maybe 80%, 70%. Whereas other things like, say, the acquisition fee, that sponsor that we're partnered with is the one that found the deal, is doing a lot of the property level due diligence, even though we're watching and overseeing it as well. So they'll get the majority of that fee. And then when it comes to that final split and promote, they'll take the majority of that fee as well, usually. And then that one's usually more closer to 50-50. But that is how we've done that. So to the investors, it's relatively fee neutral. And then people will say, why would another real estate sponsor agree to that? And the reason is because we take so much off their plate. They don't have to grow their overhead when it comes to the legal side, the capital raise side, the investor relations, the admin and accounting. And so it allows them to keep their overhead down and scale a lot faster and do a lot more deals than they would usually be able to do otherwise. We have one partner right now. I mentioned that we're doing this hotel to multifamily conversion. We've done this something like 25 deals in the last 2 years with them. So we've added a lot of velocity to their ability to get deals done and really scale.
That's awesome. So let me make sure I understand correctly. So you as a fund manager get paid on the GP side of the deal, and then you don't charge a fee to your fund itself. Is that correct?
We do charge a fee to the fund, but you have to remember, and we could go down a lot of different rabbit holes here because we invest out of funds. Again, we have 5 active funds that we're managing. We also do single asset syndications that we don't run through our funds. And we can structure deals where we'll invest the money into and alongside a GP. We'll put up passive LP dollars where we have nothing to do with the GP. And we also will help capitalize operating companies and take pieces of operating companies so they have more capital to grow their overhead to execute on their strategies. So each of those types of investments have unique structures. But so of our funds that we have, because this relates to your question, we have 2 of our funds are open-ended funds, evergreen funds. There's no end date on them. They've been around a long time. They have a lot of assets, super broad mandate. We can invest in pretty much any type of real estate out of those funds. Those funds are set up that there is no pref, and it is there's no pref and there's no profit split. All the net income just flows through to the investors because of this fund to fund argument. And I should probably stop there because I don't want to pitch our funds, but just to say there's a lot of ways to structure funds.
Right.
And even our funds are all structured really unique. And some of them we structured one way, we launched it, we raised a lot of money. And then years later, we said, we need to amend this one and we'll change the entire structure. Had to go out, get investors' consent to do that. Some of them you get to a point and say, this one's run its life, let's wind it down and shut this one down. Maybe you sell the assets to another fund, maybe you dispose of the assets. Funds are just, and this is why Verivest is so fun for myself and others that run it, is we get to talk about funds all day long, and there's just no right way to do it or one way to do it, and whether that's structuring or how you manage them or the strategies. So it's really interesting what you can do with.
Gotcha. That is pretty exciting for sure. In terms of in this market, I know a number of people are getting capital calls on their deals. Have any of the deals that you invested in have capital call?
Yeah, we've had a few recently. Yeah, we're no different than others. The deals that have variable rate debt, you saw debt service double on us, and that wasn't part of the pro forma going in. So we burned through interest reserves on a couple of deals and had to recapitalize those. We've done that sometimes through capital calls, sometimes through additional equity, sometimes through putting up mezz debt. So yes, I am familiar with capital calls. It's not a fun situation for sure, but it is part of the business, and been in it long enough, you're going to have to do some capital calls.
And then how are you doing in terms of educating your investors? Because, they had a really good run in the last 10 years. They probably didn't know that capital calls exist. So how are you doing in educating them and letting them know that, hey, this is just part of the process, part of the game?
Yeah, it's just a lot of discussions. It's just being, and this is how we communicate, just really forthright, really transparent, really to the point. We don't beat around the bush. Interest rates skyrocketed. What are you going to say, right? Our interest payments, we had budgeted for X. They are now this. We burned all the interest reserves. We're out of cash and we need more cash for the deal. And then it's laying out options. This option looks like this, option looks like this. The best option is for us to do a capital call. And that's not always the case, right? Like I said, some of the deals, we did not make capital calls. We capitalized the shortfall with other means, but in a few instances, capital calls were necessary.
Gotcha. All right. In terms of syndication versus funds, do you personally have any preference, or is it just deal specific, or what are your thoughts on that?
Yeah, it's an interesting question. For capital raising, I like raising into funds. The capital raising for syndications is stressful. You're always under the gun with this fire drill. You usually have put up some hard earnest money. If you don't raise the equity, then you're going to lose the money, lose the deal. And that's just really stressful. And I feel like no matter how much money I've raised or how many deals, that stress doesn't go away, and pressure. On funds, it's a little different where, like I said earlier, they're hard to get going, hard to get off the ground. But once you hit your stride, raising for funds is a whole different ballgame where you can get in this rhythm. And I like that rhythm of raising for funds, which you can't really get in. You're always the start and stop with syndications. So from a capital raise perspective, that's how I feel about the two.
Gotcha. All right. And then in terms of deciding on who's the manager that you would raise for, how do you decide that? Who is your ideal operator manager?
Yeah, so the ideal ones that we invest into, they're oftentimes in a growth stage. They have a good strategy that we really like. They are good underwriters. They're good kind of bird dogs to find deals. They're really good at real estate. They may not be great at how to structure this stuff. They may not be great at investor relations and that all the things that we handle, but they're fantastic at executing real estate. And so they usually have some focus on their strategy. They're not doing a little bit of everything. And yeah, we have assets of all different types all over the country with a lot of different groups. I guess another ideal for us is someone that has quite a bit of deal flow. We don't want someone that is just going to do one deal every few years. We'd love to do repeat business and be able to replicate the structures that we figure out on the front end and create a true longer term relationship.
Okay. Do you are your deals 506C or do you also do 506Bs as well?
At this point, all of our offerings are 506C. In the day, that wasn't even an option prior to 2013. They all used to be B offerings, but for now, being able to market your offerings publicly is important to us. And we do not want to take on any non-accredited investors anyway, which is a big reason that people do those B offerings. But for us, we focus on at least accredited investors.
Gotcha. Have been through the last market crash. Where are you seeing this market going? Do you see any similarities? What are the differences? Yeah,
this one's quite a bit different than I'd said. The Great Recession, it just markets completely froze in the sense that you couldn't find a lot of capital. It didn't seem to be there. Whereas now there is a lot of capital out there. And I think at the moment, it feels like everyone is just trying to figure out what the pricing should be on stuff. I'm hoping and feeling like once it's clear that interest rates are what they are, that people just get back into it. But it's definitely slowed way down as far as acquisitions and dispositions because people don't know how to price things at the moment.
Gotcha. Okay. What are some of your favorite tools that you use other than VeriVest? What are some of your favorite tools that you use in the business?
We use HubSpot for our CRM, which has been great just to track everything. And then we use probably the same tools as others, Zoom, Slack, Microsoft Teams, but we don't have any crazy tools beyond that. I think using third parties, we use VeriVest for the admin, we use VeriVest in their investor portal, and then the few things that I just mentioned, but beyond that, we don't really use anything else that's unique.
Gotcha. Okay. And if you were to do it all over again, not all the way to when you were still doing the single family stuff, but in terms of this multifamily, commercial real estate assets, if you were to do it all over again, you're starting brand new, what would you do differently to grow fast?
I think I'd do what we are doing now, and which is that we have really shifted a bit of our focus to helping to grow and capitalize other real estate managers. If you look at, I'll give you an example. So VeriVest right now has about $3.2 billion of investor capital that we do the administration for. So from my perspective, VeriVest helped give rise to all the managers that have that investor capital. And it's great for VeriVest that we make the administration revenues off of that. But I would really love to be involved in those individual managers and operating companies as to their strategies, how they're doing things, like a board of directors seat, but also taking a piece of equity and doing that through providing them with capital. And that's a lot of what we're doing now. Is I'd love to grow that number from $3 billion to $30 billion over the years and be involved in the managers that get there. That would be exciting to me. Doing it one deal at a time for myself at this stage of my career is not where I want to go. I'd much rather help other people that are doing that sort of thing or running their strategy and help them basically not make some of the mistakes that me and my partners have made over the years and use what we've learned to accelerate their growth and grow the industry. This industry, although it's been around forever, really, I watched it just totally explode after 2013 with the Jobs Act and the ability to do general solicitation and everything else. And then crowdfunding, of course, came along. It's an exciting time to be in the industry. And I also feel like with COVID, I've seen a lot of people that had one career that kind of took a pause and reflect on where they're at and say, I'd love to be a real estate entrepreneur and do this other thing. And so it's an exciting time. And I just really enjoy working with other managers to help them grow their funds.
That's awesome. If you were advising someone who haven't raised anywhere near the $100 million, and to them, that's probably like a mind-blowing number. What would you advise them in terms of whether or not, they can do it? Like how big is that number really once you get there?
Yeah, I saw this. It's a great question. The advice would be just to chunk it down. Don't think about 100 million. It's like running a marathon. Don't think about 26 miles. Think about, you got to run 1 mile at a time. You need to raise $1 million at a time. And sometimes that's going to come in the form of $50,000. And sometimes you're going to hit a $3 million check. But you got to really break it down like that and know it's going to take a long time and know that it's a grind. And the biggest thing I see people is that they just think it's going to happen and they don't put the consistent effort into it. It just takes consistent everyday effort. And just that little bit every single day is what gets to the $100 million mark. Right. But you don't just jump to it. So that would be the advice. I think if you focus on it, if you have a good story, good strategy, and you have deal flow, you can get to that number.
That's awesome. Yep. Great advice. For the folks listening in, if they want to reach out to you, invest with you, become a client, connect with you, where would you like to send them?
Given the audience here, Verivest. So verivest.com is probably the best way. You can email me. It's darris.cassidy@verivest.com. And then Fairway America is the other company. So check out that website if you want to see some of the deals or offerings or what that company is all about. So those are the two ways to connect.
Awesome. And you've been super generous with us today. Really appreciate you. How can us as the audience contribute back to you? What are you looking for?
Like I just mentioned, I'm looking to work with real estate managers and help grow their businesses. So if people are in that, looking for that, whether it's advice on how to set up funds, actually setting up funds, capital raise coaching, administration, that's interesting. If you have deal flow, whether it's individual deals, maybe your operating company, maybe you have some of those capital calls that you don't want to go to your investors, but maybe someone else can put up that capital. You have a fund that you're raising for. Any and all of those things is what I'm looking for.
Awesome. All right. We are gonna close up this portion of our interview today, but hang on tight. We're going to open up for Q&A just a little bit here. Okay. Thank you so much for doing this interview with me. I really appreciate you. It's been an honor and I've learned a ton. I love doing these interviews because I get to ask questions that I would love to learn. So thank you so much for being so generous with your knowledge and your time there.
Yeah, thank you for having me. Appreciate it.
Awesome.